Hello and welcome, dear viewers, to another episode of our Forexer channel. We are thrilled to have you here with us today. In this episode, we will delve into a fascinating topic that can greatly enhance your trading skills: understanding liquidity. By gaining a deep understanding of liquidity, you will be able to make better entries and exits, significantly reducing losses and capturing trades with incredible risk. To reward ratios. So let's jump right in and explore the crucial role of liquidity in the Forex market. In this video, we will delve into the powerful concept of liquidity from a smart money trading perspective. Understanding liquidity is key to recognizing which market moves are liquidity grabs and how to apply this concept effectively on the charts. We will guide you through a comprehensive liquidity trading strategy that is based on key principles and rules. This strategy will provide you with specific entry and exit points, enabling you to make well-informed trading decisions. So get ready to enhance your trading skills and learn how to leverage the concept of liquidity to your advantage. Let's dive into the exciting world of smart money trading and unlock the secrets of successful liquidity. Based strategies. What is liquidity? In simple terms, liquidity refers to the amount of money available in the market. Every trade involves buyers and sellers. When there is more money in the market, it becomes easier for large players to trade. Suppose a large company needs to convert hundreds of millions of dollars into euros. If they choose to do this when liquidity is low, the price of euros would skyrocket due to the high demand and limited availability. However, the company wants to buy euros at a lower price, so they require liquidity, or in other words, they need sellers in the market who are willing to offer euros at a reasonable price. The presence of sellers with ample liquidity would allow the company to execute their trade without significantly driving up the price. The liquidity zones in the market are typically where retail traders actively participate. These zones are often identified as demand zones, where buying pressure is expected from retail traders, small banks, private institutions, and other market participants. When price reaches these demand zones, traders place buying orders, and their stop losses act as sell orders. As a result, the liquidity zone forms below the demand zone. This creates an opportunity for the company or large player to take advantage of the available liquidity by executing their trades without significantly impacting the price. Once the liquidity is grabbed by the company, the price can make a sharp move to the upside, as the buying pressure from the company and other market participants drives the market higher. Here, when the price hits the trend line that acts as resistance, traders look to get by the trend line. They place their stop losses below the trend line to manage risk. This area where traders enter buying positions becomes the liquidity area. Below the liquidity range, there is a significant structure that has acted as support and resistance several times before. Suppose the price reaches this main structure level. In this case, it will be a good opportunity to trade long. Liquidity absorption at this level provides the conditions for a continuation of the price trend, which aligns with a favorable outcome for traders who want to see price action in their favor. Question: what are the benefits of identifying liquidity zones on the chart? First, an existing liquidity zone before a demand or supply area creates a perfect trading opportunity because liquidity acts as fuel for the desired market movements. In simple terms, liquidity zones serve as catalysts for price movements and represent areas where significant trading activity is expected. By entering the market at these liquidity zones, traders contribute to the momentum and direction of the price, leading to stronger and sustained moves. In summary, liquidity zones provide the necessary fuel for desired market movements, making them ideal trading opportunities to capitalize on. The second benefit of identifying liquidity zones is the ability to differentiate them from major demand and supply zones. Liquidity zones, typically influenced by short-term buying or selling pressure from retail traders and smaller institutions, may have a lower probability of success compared to major demand and supply zones. The latter represent areas with significant accumulation or distribution of orders, indicating stronger market sentiment and potential trend reversals. By distinguishing between these zones, traders can focus their analysis on areas that offer higher probabilities of success and more significant trading opportunities. In this scenario, the price broke through a structure level, leaving behind a perfect order block. If the price retraces back to this area to fill the gap, it presents an excellent opportunity to place buy orders. This is because the order block represents a liquidity zone where traders previously entered positions. After the sharp move, the trend eventually becomes exhausted, leading to the creation of multiple liquidity zones. These zones are formed as traders take profits or exit their positions, resulting in temporary consolidation or pullbacks in price. Subsequently, the price breaks through support levels, triggering stop losses of early buyers and grabbing all the liquidity available at those levels. This liquidity grab provides the necessary momentum for the price to continue moving to the upside. Indeed, grabbing liquidity before reaching an order block can present a perfect trading opportunity. However, it is important to note that this is not an absolute rule. Price can break through the order block and result in a significant trend change. To mitigate this risk, traders often look for reversal patterns on lower time frames before entering trades. These patterns provide additional confirmation and increase the probability of a successful trade. By analyzing lower time frames, traders can identify potential reversal signals such as candlestick patterns, chart patterns, or indicators that suggest a shift in market direction. On the chart, there are various types of liquidity zones that traders can pay attention to. These include trend lines, consolidation areas, major moving averages, and more. However, one key focus is on equal highs and lows. By simplifying the concept, traders can identify areas where the price has previously reached equal highs or lows, indicating potential liquidity zones. These zones represent levels where buying or selling pressure has been significant in the past, and therefore they can act as areas of interest for future trading opportunities. Now that you've grasped the concept of liquidity, let's delve into our key liquidity trading strategy. Before we do that, if you've enjoyed the video so far, please give it a thumbs up and subscribe to our channel, as it greatly supports us in producing more videos like this. A trading setup that is not limited to any specific time frame and can be traded in Forex, crypto, and stock markets is a straightforward approach consisting of two major steps. In the first step of this trading setup, we identify the trend using an exponential moving average. Specifically, we apply the EMA 50 on the chart. Our goal here is straightforward. We watch for the price to break the EMA in one direction and make three distinct moves, with the third move breaking the previous market structure. For example, if the price breaks above the 50 EMA, it should ideally make 1, 2, and 3 upward moves, ultimately breaking the prior market structure. This indicates a bullish trend, as long as we remain above the higher low, and we will exclusively seek buying opportunities. In the second step, we actively look for a liquidity sweep pattern. In the second step of this trading setup, you wait for the price to establish a support level. This support level can be confirmed by either 1. Wicking below the support. The price may briefly dip below the support level, creating a wick below it. This is often seen as an attempt to grab liquidity from stop-loss orders or trigger short positions. 2. Closing below the support and reversing. Alternatively, the price may close below the support level, but then quickly reverse and move back above it. This could indicate a false breakout or a stop. Run to grab liquidity from traders who panicked and sold when the price closed below support. Either of these scenarios is considered a liquidity sweep pattern, and it can be a potential entry signal for traders following this setup. You observe the market as it establishes a support level and potentially initiates a liquidity sweep with a long wick candlestick. At this point, you have two options for entering a trade. Enter immediately after the long wick candlestick. Wait for confirmation by looking for a subsequent candle to close higher than the previous one. Your stop. Loss is placed below the low of the long wick candlestick to limit potential losses. Your profit target is set at the next level of structure, which is determined by your analysis of price. Action. You also have the option to manage your trade by closing half of your position when the price reaches your 1 to 2 target, effectively locking in some profits while letting the rest ride. The key point to always consider is looking at the higher time frame to assess the price's position and the available room for it to reach the next level of structure. For instance, on the same chart just before placing a trade, if we zoom out to a 1-hour time frame, we can observe that the price recently broke to the upside of the structure. It has significant potential to move further until it reaches the next level of structure. Furthermore, if it breaks the higher low to the downside on this higher time frame, we will seek shorting opportunities on lower time frames until it reaches the next level of market structure. It's important to note that all the concepts we've discussed apply specifically to bearish scenarios. Let's examine a bearish example on the EURUSD 15-minute chart. We can observe that the market broke below the EMA 50 with 1, 2, and 3 consecutive moves, indicating a bearish bias. Following that, the market encountered resistance and subsequently broke above it, capturing liquidity and promptly returning to the previous trading range. This occurrence is commonly referred to as a failed breakout. This is the point at which we execute our trade. It's worth noting that this strategy is adaptable to various time frames in trading sessions. However, conducting your own backtesting can help determine which parameters work best for you. Discover Hanko Trade, a captivating and intriguing broker offering a distinctive trading experience. Don't miss the opportunity. Open an account now and witness the remarkable difference. The registration link awaits you in the description. I hope you found this video informative and helpful. If you did, please consider liking and subscribing to our channel to support the production of more content like this. Feel free to share your thoughts and questions in the comments below as we strive to address all of them. Thank you, and I look forward to the next episode.